Right. So basically, we are structured as a research analyst. Our expertise is only research. We leave everything else to the other people, and our focus is retail customers. That's how we are sort of structured. Uh, and this is my quick background. So before starting Wealth Culture, I was working as an investment banker for a good 7 to 8 years. I was with a full service investment bank called Edelweiss, and then prior to that, I was with a boutique advisory firm called Janskar Advisors. And over the last 7 8 years, had good sort of built good understanding of how entrepreneurs go about scaling their businesses. How do they do what they do, essentially their own decisions in terms of IPOs, how to do an IPO, how are these IPOs marketed for basically the public, and what essentially goes behind and within the scenes. That is something which I have a very keen understanding of. And then I was doing personal investing for a very long time until I decided to do this full-fledged, essentially helping retail investors. Because I've personally seen a lot of friends and family people lose a lot of money doing random stuff in the markets. And that's basically my motivation to start this, practice. So let me just quickly get into our investment philosophy, and we'll cover all the aspects that Falak sort of mentioned. So you see, we call ourselves active investors. We are not the passive guys. We are not investing in the index per se. We are investing in specific securities which we believe have high potential. And that ways we believe we are much better structured than a mutual fund. So just to give you a small context, for example, one mutual fund you invest, you'll have at least 60, 70 stocks, if not more. And then people have exposure to 2, 3 mutual funds. And if they diversify properly, they have basically exposure to more than 200 stocks. So once you start to have exposure to 200 stocks, it is essentially as good as the index. It's very important. It becomes very difficult for a mutual fund manager then to start beating the index. And this is a structural problem. This is not to say that one mutual fund is better than the other. Obviously, there are some mutual funds which continue to do slightly better than the index, but this is a typical problem structurally why mutual funds cannot beat indexes over the long term. And then you have 2.5% commission, so your net returns are actually less than mutual funds, right? So in terms of our approach, we are structured in a much better way because we are not investing in 60, 70 stocks. In fact, ours is a core plus satellite approach. So the image that you see here, core allocation is companies that we like a lot, that we are comfortable holding for 10, 15 years if there is nothing going wrong in those companies. And satellite approach is these are our short-term bets. And short-term could be anywhere from 1 month to 2 years, right? But it will not go to 5 years, 10 years. That's not the short-term I'm talking about. So here we have situations where, there are sector rotation opportunities. So we find some cyclical stocks where we can, invest at the bottom and then exit at the peak. There could be some special situations also where, a lot of value can be created quickly in 6 to 12 months, that sort of situation, right? So these situations, we call them satellites because we keep rotating them in our portfolio. The core stocks, we don't touch them. Core stocks are core stocks. We will not do an SIP here, but then we will also not sell them soon. And we'll buy them whenever there is a major correction in these stocks. So let me give an example, HDFC Bank, HDFC Life, companies like Asian Paints, CDSL, IEX. We like these stocks over the long term because they have monopoly, they are good businesses, premium businesses. It's just that I am not comfortable buying them at all sorts of valuations. So I will be very sort of particular about the valuation at which I enter into a company, and hence I will wait. So let's say if a TCS goes from 25 price to earnings, it touches, let's say 40, 45, which it did very recently, then I will not go and buy TCS at 40, 45 P, right? But when it comes down back to 20 or less than 20, then I will increase my stake in TCS, right? So we are very particular about the price at which we enter into these good companies, because buying good companies at high valuation is actually not a good investment, right? So that's how we rotate. We are very particular about valuation. Uh, you know, uh, Something that doesn't meet our valuation criteria, we will not put our money there. So that's the typical approach. Now we are only talking 10 to 15 stocks here. So even in our small case portfolios, even in with our clients, we do not advise more than 10 to 15 stocks for a couple of reasons. We have very limited amount to invest. Second is we do not want to over diversify. Uh, and third is wherever we have high conviction, we want to put more money there. I know as advisors, we also put our money along in the same stocks that we tell our clients to put, right? So we have enough skin in the game to sort of, keep doing this, tell them, what to buy and sell, right? So, and that's how we sort of intend to create alpha for our investors over the long term. Now, quickly, I want to talk about our fundamentals. So, there are 10, 15 slides. I'll try and cover them quickly. This is how we sort of go about selecting stocks, and then we'll get into Q&A sessions also. But fundamentally, the risk and reward have to be aligned. So I'm not going to take high risk for low returns, right? Essentially, I would like to take as little risk as possible for as high returns as possible, right? So the risk and return should go along. That is very important. The second important thing is we should understand and like these businesses. So any business that we don't like the management, we don't like the business model, we don't like how this company is making money. It could be commodity stocks, it could be, some people don't like to invest in smoking companies, some people don't like to invest in liquor companies, right? So everybody has his own preference of what they like and what they don't like. But we don't have any such preferences. But yeah, basically we have to like the business in terms of how it is conducted, in terms of how it helps different stakeholders involved, that sort of thing. And obviously that starts with the management. So if you don't like the management, then obviously we don't like the business also, right? So and has to be enough difference between the valuation and the price that we're paying. Obviously price has to be lower than the value we think we will get out of this stock, but essentially the price has to be much lower than the value, because in 10 to 15 stocks, so ideally for the kind of investors that we are not looking to make 10-15% here and there, right? That's not the typical stocks that we would have in our portfolio. Typically we are looking for long-term value migration thought processes, where you are looking at least doubling, tripling your money over a period of time, because of growth in the business, the growth in the industry, a lot of tailwinds helping the business grow and stuff like that, right? So price and value, 10-15% difference doesn't cut the bill. We are not interested. The difference has to be more than 50-60% or even 100%. It is then that we are interested in holding and investing in such companies. Revenue growth is the most important. I can't tell you how important it is. For as basic as revenue growth has to be there. Revenue growth nahi hoga to how we don't like to invest a lot in value deals typically, because what happens is value investing typically ends up becoming a value trap. The very few situations where you will see that a value investing approach has actually created money for you. And even if it creates money for you, there is very limited delta that you can actually make in investing in value stocks. Because let's say you bought something at 4 ka PE and it went to 10 ka PE. So that's the sort of profit that we are looking at, versus investing in, let's say, HDFCs, Bajaj Finance and companies like that, which keep giving you returns year on year over the 10-year period. I don't know, it has given 100x return or more, right? So typically we don't like a lot of value businesses. So revenue growth is very important. We are not so sticky about PE as long as the premium is justified. But even for value businesses, we look for at least a 10 to 12% growth. And for growth business, obviously, we're looking at much higher 20-25% growth, right? That's our sort of criteria to select value and growth businesses. And obviously, like I mentioned, there has to be proper triggers in place. The industry has to support, the business cycle has to support, management has to support. There could be a significant amount of capex also happening in the company. These are things that we look at when we sort of time our investment in a company, because most likely situation, the stocks will just keep going sideways unless these things come into play. And that's when these things become very interesting, and it sort of start looking like a multi-bagger opportunity. Quickly, what are we looking at when we do growth investing? So growth we want at least 20-25% CAGR for the next 3 to 5 years. We are looking for margin expansion. So growth at the cost of margin is not for us. We don't like businesses where growth is coming at the cost of margin. Margin has to keep improving, ideally. The company has to have low leverage, and the third important point is that growth should not be funded by external capital. Now, this is something that we don't understand in a lot of cases, but it's very easy to raise money and just keep growing, versus to be able to fund your growth through your internal accruals, right? So we don't like businesses that keep growing by raising external capital. We would want as much less capital as possible to be raised externally, both from debt and equity point of view, so that existing shareholders are not diluted, and the value is not passed on to banks. Actually, a lot of companies actually run to serve the banks. They will just keep paying principal and interest to these banks, and we shareholders just keep sitting and don't make any money. The fourth and the fifth important point, management, we touched upon. We do not like buy at any price investing. We never do that. Like I said, we're very, very particular about the valuation at which we enter into these companies, no matter it is the most premium company, but we will not overpay for something. So growth at reasonable price is something that we practice. And business mein kuch moat hona chahiye. There has to be some competitive advantage that we understand. That's when we says, we have to understand and like these businesses. And if we sort of understand the moat and the competitive advantage, then we can even go slightly more aggressive on these stocks. That's the idea. In value businesses, like I said, something is available for 6p, 7p, 3p. But if it's not delivering at least 10% CAGR, I am not interested. Inflation itself is running at 6%. So if a business can't, give you returns net of inflation, if it is not even delivering 5-6% growth on top of that, then there is no growth only, right? So it doesn't make sense to invest in such companies, no matter how cheap they are. Most likely there'll be value traps, and I've talked about this in our YouTube videos also. But then low valuation has to be combined with a couple of factors that will be some sort of game changer for this company. It could be change in the management, it could be launch of new products, it could be change in the industry dynamics, for example what we see with ethanol. It could be significant deleveraging where some sort of external promoter has come in, paid off all the debt, and now sort of investing in creating new products, building new designs, launching new products, essentially doing more capex. So these are 4 or 5 aspects, which when they start to show up in a story, in a stock, it starts to make sense from a value investing point of view. Otherwise, most likely the stocks will just move sideways or go down. It can become even cheaper. Averaging in these stocks is very, very dangerous. So never average in a value stock. Always buy when it is going up, right? And the good thing about this is that there is enough margin of safety because you have good dividend yields. So those are like very, very basic. You have to have those when you are doing value investing. But then that is not why we are investing. We are investing for growth. We are investing for capital appreciation, and hence a lot of these factors also have to come in. Beyond that, we do not invest all our money in one go. We always invest in tranches. In fact, we exit also in tranches. And when do we invest? When we start to see more and more performance from the company, which means the company has started to deliver on its growth, on its revenue, on its profit margin. That is when we'll buy the stock as it moves up versus when it starts to go down or becomes even more cheaper, right? That's when we believe we have found the right value company which will create money for us, right? So investing in tranches is very important. And so the three most important words when you are investing in a value stock is execution, execution, and execution. If there is no execution, the promoters are not delivering on what they are promising, then most likely you should get out of these stocks ASAP, right? What we avoid very good businesses at super high valuations. So buy at any price investing हम नहीं करते, हम करना भी नहीं चाहते. हम ऐसे कंपनीज को उस वैल्यू पे अवॉइड करते हैं. हाँ, अगर वैल्यूएशन अच्छा मिले, HUL for example was available at a 5-year low PE last month at a PE of 50. So I told a couple of my clients to buy HUL, right? Because they wanted to invest in premium stocks, and it was available for a very good valuation. So that is what we do. There is a timing to make entry into these stocks. We help our investors time those stocks because we consider ourselves as active managers. There are different approaches to this. Some people will say, "Nahi, just keep doing your SIPs," which is also fine, by the way. I'm not against it. I'm just saying that we are slightly more active in our approach. We avoid value traps without any future catalyst or positive triggers. So like I said, सस्ता मिल रहा है कोई company, I will not buy unless there are some serious triggers that are at play. Cyclical businesses at peak valuations, I will not buy. Tata Steel, I will not buy. I would have not bought. I didn't buy it even in Jan, Feb, September, October, because even though these research reports saying are deleveraging ho gaya, the books are clean, but this is all history, right? So it's all basically a cycle. So that cycle is over. You need to get out. You can't just keep holding Tata Steel at such a high price. It will most likely. So if any of you are listening to are already investors in Tata Steel and you bought it at September, Jan, Feb, the steel cycle is gone, by the way. So there's significant amount of time before you actually start to make money in case you are holding it in anticipation of the stock going up. So these are cyclical stocks. We will not buy them unless they are again in our buying criteria. So the buying criteria is super important. That's where we believe our advantages, that's where we believe our expertise comes into picture, because otherwise, good stocks, everybody knows HUL, TCS, HDFC, these are all public names out there, right? And most likely we will not even advise in these stocks, but yeah, our basically advantage is that the value that we bring on the plate is that we help you sort of get an entry into these stocks at good values. Goes beyond saying, but poor corporate governance companies, we don't invest. So Broadcom, very, public, a lot of people have invested, but I don't like this company. We don't like this company because of, again, corporate governance issues. We've avoided it, we'll continue to avoid it. Public sector enterprises, again, we don't like PSUs much. No matter if these are value plays, no matter, and we are fine letting some of these companies become multi-baggers, and we are happy to miss these opportunities, right? We are not here to catch every multi-bagger out there in the world. That's not our expertise also. We are happy to sort of let some multi-baggers pass by without having to worry about it. And when do we exit? So basically, this also covers our rebalancing strategy. We find a better investment opportunity, we will exit something when the story no longer holds true, which means we did a mistake in our assessment of the business and the company. And we do that quite a while. Quite a few times we've done our mistakes and we exited those positions once we realized our mistakes. Even if it at a loss, we will exit those positions, because it is good to sort of acknowledge your mistakes and take your exit at the right time, rather than just keep waiting for the opportunity to go up. Most likely situation, the stock is never going to come up. Third, when the stock becomes extremely overvalued, for example, IEX went till, I think, more than a P of 70. So at 70, very difficult to make money for the next 1.5, 2 years, right? So it's not that I have a problem holding the company, but then I also know that for the next 2 years, nothing is going to happen to IEX. So in situations where we're slightly more active, we'll probably book our profit, we'll move out, we'll deploy that capital somewhere else. So that's how we rebalance our small case portfolios also, and then we'll enter small, IX again when it is available for slightly cheaper values. For example, I think it has already come down to P of 30 from 70 odd P. So, and we're waiting, we've still not invested, we're waiting for a better opportunity. Once it sort of comes into our buying range, we'll buy again, right? So because we are active, so we do this quite a while, because we're not comfortable just sitting in a company 2 years, nothing done, right? And that's and nothing to, I'm not to say that if you're still holding, you are doing something wrong. I mean, that's completely fine as long as you don't buy it at a P of 70. So let's say you bought it at 30, you're still holding it at 70, you're still holding when it comes back to 30, and you buy when it again goes below 25. That's a completely normal approach. If you're a 10-15 year long investor, you should do that. It's just that we are slightly more active. Now, so Falak, asked me to cover one case study which sort of embodies all of these aspects. Now, the way we like to talk about wealth culture is that we have our expertise lies in picking small micro cap, mid cap stocks, right? That's sort of our expertise. We are not too worried about the HDFCs and the lives of the world. They will definitely do well. We just have to time them. Whenever the market gives us that opportunity, we will make those entries. But most of our time basically spent on identifying the next 10x, 20x, 30x stock, which nobody's writing about, which nobody's talking about. So that's where our expertise, that's where we spend a significant amount of our time. Personally, for my own portfolio, as well as some of my offline clients where they are looking to make higher returns over the long term. So let me explain how we go about doing that through this company called MacPower CNC Machines.
Ujjwal bhai, just a second.
Yeah.
Before you proceed, I have few questions, and
Sure.
if any of the audience have question, then it's better to ask it upfront. So you said you have around 15 odd companies in your portfolio, right?
Yes.
And that is bifurcated in core plus satellite.
Yes.
So is there any weight like 50% in core and 50% in satellite? Means 50% you are looking at robust companies and 50% you are willing to take in risky bets somewhat. Is there any criteria like that?
No. So, what happens is out of 10, 15 odd stocks, you will typically 6, 7 are core. Okay. And the remaining are mostly cyclic. For example, I'll tell you, currently, I guess the whole market knows about it now, but we took this call in March, this year when it was not so much discussed, but we are invested in auto, slightly more bullish on auto and banking sector, because we believe that cycle is coming off now, right?
Okay.
So what we've done is within our satellite portfolio, which is the remaining 10 stocks, we will have, let's say, 2-3 auto stocks, then we'll have 2-3 banking stocks. So we will slightly go heavier in terms of our allocation to the sectors where we believe next 2-3 years will be game changer.
Okay.
But not to say that all 10 stocks are only auto and banking. Right. We also have our infra plays. We also have our FMCG plays. We also have our some small cap stocks and cyclical plays also.
Okay.
Special situations as well. So just taking examples here, just taking names. These are not recommendations. For example, Mirza International is looking like a special situation where there's a demerger situation. Right. Delta Corp, for example, is looking like a special situation because the Delta Tech, which is their subsidiary, the online gaming business, will probably go for an IPO by the end of this year.
Okay.
Right. So these are situations which sort of which are also part of those other 10. And then in the core sectors, we'll have the IT companies of the world, some technology stocks which are growing 30-40%. So that sort of balance we keep. Obviously, there's no fixed rule as such. There's no maths to say. But 6 to 7 core stocks, remaining are satellite stocks. We could these numbers could change slightly. and we rebalance to make sure that we are not taking overexposure in anything. Yeah, at some and places where we have slightly higher conviction, we will allocate slightly higher weightage
Okay.
also. But in any case,
And,
the
and
weightage,
any
yeah,
and any stock specific weightages, capping on any stock specific.
yeah, that's what I'm saying. So typically, we will not exceed 10% in any stock.
Okay.
Yeah. So
Okay.
even if let's say we are bullish on something, we'll cap it at 10%.
Okay. Okay. And do you use technicals?
So technicals we don't use. Uh, the way we deal with it, and the way people. So so let me compare how technicals and fundamentals work, right? Uh, so fundamentals, you will start to see things like capex. You will start to things like new product launches. You will start to things like management change, right? So
Right.
these are things which are now showing you that something is happening in the company. This will be corroborated with volume increases in the technical charts, right? So in the technicals, you will start to see that okay, now the volumes in this company are picking, right? The but to be honest, I don't have a lot of information about charts. I don't look at charts very often. We are comfortable buying something and waiting for this to evolve,
Okay.
right?
Right.
It's not that I will buy a stock only when the stock starts to move, uh, that the 50-day average starts to go above the 200-day average, right? That's not what we do. If something from a valuation point of view, from a growth point of view, starts to make sense, I will buy and hold it. Uh,
Okay.
so we're not really looking at technicals too much.
Okay. And just two more questions. Looking at the dramatic shift in the inflation in the macro environment, do you apply any of those in your process? And if yes, is there any weightage like you do to any macro?
So we try and understand these things as much as possible, right? So macroeconomics is so much complicated that's very difficult to predict intelligently uh, what can or would happen in the future. In most situation, uh, you will come through a surprise. In most situations, right? So
Right.
you thought something, and then you are up for a surprise 6 months down the line. Something else that you've not even thought can come up, uh, right? So we try and learn as much as possible. What I've felt is that it's very difficult to incorporate these things when you are a value investor, right? Because essentially we are not investing in the index. So if for example, just taking names here, no recommendation. If Delta Corp is looking like a cheap stock now, I will buy it even if there is a chance of recession, right? As long as this stock is available in my buying zone and at my valuation, I am comfortable putting more and more money here. Obviously, given the cap that we have, but if everything is met, then I will buy these stocks because, for example, let me just give you an example of how it can and would potentially affect. So, for example, a lot of IT stocks, right? IT stocks have gone up. They went up in terms of valuation. They went to 60, 70 P, and now they are at 30 P. So some people are saying this is good time to buy IT, right? But one could think of it this way that 80-90% probability of recession in the US, and we are so
Yes.
much
Yes.
exposed to US as an IT business. We are super exposed to US and Europe. So then that means that even if it goes down to 25, 20, basically there's more correction coming in IT stocks if one has to think that way,
Mhm.
right? Because if
Right.
something was growing at 20-25%, most likely it will only grow 10-15%. uh, so so business wise, we do analyze micro, right?
Okay.
so
Okay.
so IT stocks, I can see there is some sort of slowdown coming because of a US recession, and hence to that extent I am not so bullish on IT right now, uh, also given the valuation that these companies are trading at. So I would be more comfortable buying these companies at below 20 PE. uh, Now, whether that comes because of recession or because of attrition or something else, right? But can only buy once they are below 20. So that's the sort of thought process there.
Okay. And just like you have mentioned that if the stock is falling, let it fall, and you should
Yeah,
buy only when it recovers back. So how
So,
a retail investor prepare themselves mentally in such
so
stocks where they say that don't catch a falling knife?
yeah, yeah. No, no. In fact, I'd like to give you one example where I myself sort of am slightly trapped. Okay, this is a honest confession. So I
Mhm.
like Web of Global a lot, right? In
Okay.
fact, I like Web of Global more than Nika. Same line of business, but in a much better market, right? So Web of Global, I have been asking my clients to buy at even at 30p, 30, 35p, right? For the quality of the business that is. Now, what has happened, Web of Global has sort of corrected significantly. I mean,
Mhm.
it came down from 900 odd levels to now trading somewhere like 300 plus. Again, no
Yes.
recommendations here, just for discussion's sake.
Yes.
So,
Yes.
so what we asked some of our clients to average down, okay, because we thought it was cheaper, 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 right? It's getting cheaper, cheaper, cheaper by the day.
Right.
But what is happening is that the company is also not performing in terms of quarterly results. So if you look at the most recent quarter, Q4 of FY22, their margins came down to 6%, right? Now I know why it came down to 6%, and I know that it will improve. But again, for whatever equity markets are risky, there is no surety, and the waiting on some of these companies in anticipation of good results can sometimes people can lose out patience, right? So the better thing than to do is basically not do considerable amount of averaging even when good stocks are going down. Okay.
Okay.
uh, but let's say when you can average, okay, so let me tell you when you can average. Cyclical companies, please don't average down, right? It is almost a sin to average a cyclical company as it is going down,
Right.
because most likely you are in for a long term of losses. 4 to 5 years also it can go where you can just sitting on losses. Eventually you might decide to book your losses and move on. So cyclical companies never ever average. Only when you have good fundamentally strong stocks can you average, but then only then average once the valuation range is very very low. And what do I mean by low? So for example, the 5-year PE of a company is, let's say, 30. Okay. So
Mhm.
look at the PE chart of the company over 5 years to 10 years. So IX, for example, moved from 30 to 70. But if you look at the 5-year PE chart of IX, it is 30.
Right.
So once IX starts to come down below 30, below 25, below 20, that's when it starts to become a buying opportunity. That's when you average, right?
Okay.
Uh,
Okay. Okay.
Obviously, nothing is sure shot, but
Yes. Yes.
for the
Yes.
for the quality
Absolutely.
of business that IX is and the price that you are buying at, it is a much better sort of bet than buy it at a P of 70, then 60, then 50, then 40, right? Don't do that thing.
Okay.
If you've bought something at a P of 70 by mistake, we all do. We are retail investors, we don't understand, or maybe we are just driven by the fear of missing out. So if let's say you have bought something at a P of 70 and you want to average, please wait for it to get below its 5-year or 10-year uh, you know PE. Uh,
Okay. Okay.
and then you buy an average sum. Don't buy as it keeps falling, because
Okay.
you only have so much to invest, right? Most
Yeah.
likely you will run out of fuel. You will run out of
Yes.
more money to invest.
Yes. Yes. Two questions from the participants. How can you identify business trends which you can accumulate, and where do you see chemical space right now?
So chemical space, COVID was the best year. Chemical space, in fact, to the extent that there was very little distinction between commodity and specialty, right? In a lot of these cases, people, even managements as well, they start to portray their business as specialty, uh, when a significant part of their business is just
Yes.
pure commodity,
Commodity chemicals.
right? So it's very important there to understand what is commodity and what is specialty, and how much valuation to pay for what quality,
Right.
right? So that and this is asset to asset. Again, I'm not commenting in general. Understand the business model, understand how much commodity, how much specialty, and accordingly buy it at that valuation. So a commodities chemical stock typically should be bought, if not anything, at least below a PE of 15, right? I mean, even if you're super excited about the business and the growth, new capex coming, whatever, never go beyond 15 PE when you're looking at a commodity, even if it has, let's say, 10-15% specialty coming in, right?
Right.
Because most likely the specialty thing will take 4 or 5 years to get to 40-50%. But then you have this 80-85% commodity business, which will continue to drive your margins up and down significantly, right? So unless there is 50-60% specialty business, don't go and pay a PE premium of 20-25 to these chemical stocks.
Okay.
Right? Yeah.
Right. So, and last question was, how do you identify business to accumulate for next 10 years?
So, sorry, Falak, your voice was slightly faint. Can you please repeat?
Yeah, how do you identify business to accumulate it for next 10 years?
See, good question. So there are 3-4 things they should look at. You should look around and see what is happening around you, right? And then see if you can find a business in that space to invest. So
Italian style.
Sorry?
Italian style.
Yeah. So for example, you will, a lot of you would have noticed that more and more Indians have now starting to travel via air, right? A lot of Indians would have actually traveled by air over the last 5-6 years. I mean, that number is just growing. Now, how can you make money through this value migration trend? Are there some companies that you can invest in? Because this trend will keep growing for the next 10-15 years. We are a 130 crore population, and a lot of people still to fly by air. So are airline companies good to invest? No, those are again loss-making companies. Even the company with the largest market share today is loss-making, Indigo, and this company has been able to grow its market share, but still loss-making. So I wouldn't. So look at the proxies. If the direct company that is involved in this industry is not making money, look at proxies. So can I invest in a VIP or a Safari, which is a proxy for this whole?
Right.
Can I invest in some other company which is benefiting from this long 10, 15, 20-year trend? So that is one trend, right? The other trend is mobile and internet and digital. This is the second trend. So can we look at some digital businesses which have a 10-15-year horizon, and then invest and just let those businesses do well for the next 10-15 years without disturbing them?
In that space, do you have any consumer tech stocks like Zomato, Paytm? Do you have any interest in any of those?
No. So fundamental is profit making. Like I said, we don't like businesses that grow by raising external capital, right? So unless the company starts to grow on its own without the need to raise external capital or debt, either equity or debt, we don't like those businesses. So the growth has to be self-sustainable.
Okay. Now let's move on to the Mac Power CNC business quickly.
Yeah. So this is a micro cap stock. Like I said, the market cap of this company is only 218 crores. And this has all the elements of a very niche good business. I'll tell you why. So Mota, I will tell you, this business is growing at 20-25% CAGR. It has been growing traditionally also, and it will keep growing in our opinion for the next 3 to 5 years. So that is one fundamental thing, that growth is happening. Second thing is margins are increasing. So it's not that the growth is coming at the expense of margins. No, growth is coming, margins are also coming. The management in our assessment is a very honest management, capable management. It is among the top 6 players in the industry that it operates in. And there's a huge market out there. So for 55% of the CNC machines are computer controlled machines. So these are automatic machines. So eventually our manufacturing is also going to get more and more automatic, where you just enter the codes and the machines will cut out the pieces. Whatever design you designed, it will just automatically cut out the pieces, and you don't have to do anything. So there is long-term trend in the sense that India is becoming like a manufacturing hub. There is industry 4.0, so there's more and more push towards automation of manufacturing. right? So this is a value migration trend. This is a trend that will continue for 10, 15, 20 years. So that is the other thing which is supporting. So there's value migration supporting the business. There is the business itself is delivering 20-25% CAGR. There is margin expansion. The company is among the top 6 players, and there is a huge market opportunity out there. So in India, 30,000 CNC machines get consumed every year. This company is only making 1,000 right now, and the plans to make 1,300 to 1,500, in the next 1 or 2 years. And after all of this business is available at a PE of less than 15, right? So check out this company yourself. Very good ROE, very good ROCs. And you know what? So I really like some of these hygiene factors. And you should start to notice this if you are a nuanced investor. The small company, typically 200, 300 crores, even companies till up to, let's say, 500,000 crores, they're not essentially required to do a con call. But this company does analyst conference calls quarter on quarter. They are not ideally required to do that, but they do that anyway. It shows that the management is more than willing to speak to investors, more than willing to sort of clarify about the company, talk about their numbers, and also commit to performance. That's very important. So some of these hygiene, what are the other hygiene factors that you can look at? Stuff like what's the quality of their annual report? What is the level of data that they are giving out in the annual reports? Some of these things are hygiene factors, but then they tell you a lot about the quality of the business. Very simply, if I have to give a very simple example, for example, how do you identify whether a company is good or not, right? So you go to their washroom and look at the quality of paper that they are using, to dry your hands. That will tell you the quality of the business that it is. Look at the quality of the soap that you're using. Look at the quality of. So these small things will tell you what the management is and what they're trying to do and what the aspiration is, right? So we look at some of these we take these hygiene factors very seriously. So there's one company, I will not name it, but we did like the numbers of the company. And but we went to their website and their website was not fully operational. We then looked at the annual report. In the annual report, the numbers were not formatted properly, and I lost all my interest. Whatever thought process I had, and whatever aggressiveness I had in terms of evaluating that company, it all just faded away because it was not even sort of doing these basic hygiene things. And we decided not to invest in that company, right? So these things are very important for us, because we do not have access to the management directly. And in most of these cases you wouldn't, because these very small companies, they will not come and talk to you, although we try and do as much as possible. But yeah, look out for these simple hygiene things which will tell you about the quality of the management and the business that they're in. Now, let me also talk about some other unique things. So it's a very low cost producer. So this company is actually manufacturing CNC machines at a cost which is lower than China is doing. So in that sense, that's a huge advantage. It has very high asset turnover. The promoter holding is more than 70%, 73% promoter holding. Again, a zero debt company for a 218 crore market cap company, free cash flow positive, best return ratios, and the widest range of products when it comes to their product range. And they are increasing capacity. They have something called as the Nexa group, which means they are now moving from turning machines, which is turning is a very common machine. So they are now moving to vertical machining centers and horizontal machining, which are slightly more difficult to make. And that's where the import substitution comes into picture, because a lot of these high-end machines are actually imported. So this company will now start to manufacture high-end machines, and that will lead to import substitution. And obviously, the whole Atmanirbhar Bharat and PLI schemes also sort of supporting this company. So look at the quality of the company. It's a high-growing company. It's a profitable company. A lot of business tailwinds, and available at less than P of 15. By the way, this is not a recommendation. Please, analyze this business or talk to your advisor on your own before investing. But I'm just trying to say the thought process that sort of goes into investing in such micro caps stocks. And not just this, let me tell you. So after we evaluate more than 50 companies, we come across one such situation. So let's say we would have evaluated 200, 250 odd companies just to find 4 or 5 of these opportunities where, and here again, we will not invest in one go. Here again, we will do investing in tranches, which is we will track the quarter on quarter performance of the company and then invest more and more as the stock price goes up. We will not invest when the stock price is going down. So what happens is over a 2 year, 3 year period, you will see that the companies you are doing that are doing well for you, you have a bigger position in those companies. And there are companies that are not so doing well. Either you have exited those companies or your position in them is very, very small. So this is our risk management process, right? When you are sort of investing in micro cap type of companies, how do you sort of optimize for the risk? So this is how we optimize for the risk. Any questions here? And I quickly talk about my small case portfolios, and also one additional thing that I thought will be very interesting. I'll also talk about that. Any questions here?
There are a few questions related to which sector do you think is
Sorry, Falak, I couldn't get that.
which sector do you think will turn out to be good sector for next 5 to 7 years?
Yeah, so look for something like airlines, technology, communications technology. Even travel tech is now looking good after the COVID thing. See where the electric vehicles is now an emerging segment. It will definitely do well for the next 10-15 years. But again, don't just buy any electric vehicle stock. Look at the valuation, decide your entry point. All of these things have also been looked into. So yeah, I mean, look at the 10-15 years, what new is going to happen, how our business is going to change, which are the businesses that are better prepared to handle that change. Some businesses are not prepared to handle change, right? For example, Maruti Suzuki, for some reason, is not ready to accept the fact that electric vehicle will be the next big thing. They still keep going back to that same old statement saying that electric vehicle is not a big market. But that's what Kodak did with their cameras, right?
Yes.
It's not that they were not doing research and development for the next leg of product. They were actually doing it, but they were not making products out of it. They just thought it was not big enough. The thing is, you never know when these things start to become big enough, right? And that's when you are in for a surprise. You're in for a big surprise. And a lot of big companies have seen big surprises for all the money that they have spent on ER&D, marketing, and stuff like that. So I would rather go and invest in a company that is proactive in launching new products, even if the execution is slightly slow. I'm fine with it. Even if electric vehicle takes 4 or 5 years, but I don't want to back a company that is not even prepared to sort of launch products to that extent, right?
Right. Yeah, you can continue with
here the only thing I want to talk about is, see, when you are evaluating these new ideas to invest in, be very sure about the commercial bit of these. So I want to give a small example here. So for example, let's say batteries, right? Now batteries is good. People say batteries is the next big thing because everything's going electric, blah, 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 blah. But then what are the problems with batteries as an industry itself? So batteries, the technology is changing very fast, right? So every 3 years, you will see new battery technology will come, which will say, no, now with a 1 hour charge, you'll actually be able to do 500 kilometers. And 5 years down the line, then we'll say, no, with 1 hour charge, you actually do 1,000 kilometers. So battery technology keeps changing. So right. I don't want to invest in a technology which is changing so fast, right? Especially in a capex heavy industry where, let's say if I put a factory for 500 crores to manufacture certain quality of batteries, and what happens 3 years down the line when that whole, battery technology changes, then I have to trash away all that 500 crores I put in another 500 crores to build the next manufacturing line. That's not a business I want to get into, right? So economies of scale, which means what are the businesses where scale will come, but you will not make money from that scale. For example, mobile phones, right? Mobile phones, newer mobile phones, earlier 2 GB RAM, 8,000 rupees. Now 4 GB RAM, 8,000 rupees. Tomorrow 16 GB RAM will also be available in 8,000 rupees.
Right,
Right?
right.
So the
Technology
technology,
obsolescence.
yeah, exactly. So don't invest in such companies, because what will happen is these things are getting cheaper and cheaper.
Right,
It's not
right.
that these companies are starting to make more and money. So
Yes.
be very specific about where in the value chain is somebody making a money. For example, airlines not making money, so skip that. Batteries
Right.
won't make money, so skip that. Look at companies which will be able to make money given the long term trend. That's very important.
Okay. Okay. Thank you. And you were,
Yeah.
yes,
So
yes,
quickly,
yes.
small cap, our small case portfolios. This is where we believe we can help a lot of retail investors make money, avoid big mistakes. Whatever 1 lakh, 2 lakhs you have, you can start with our small case. As you can see here, this large cap portfolio is focused on capital protection, and given the massive correction in the market, we've been able to protect our capital. So 3 month returns, you know how badly the market got hit, and still our 3 month returns is we are in the positive zone. Unlike the small and mid cap, which obviously is a risky bet, so here you should be able to sort of be more patient, not panic. These are good ideas, but what the way we see it, these are available at 15-20% discount. They've actually recovered a lot. So a lot of investors who invested, let's say 1 year, 2 years before, they're actually in profit. But yeah, I mean this is the 4 month performance, which we obviously look to beat. Just like we've beaten this, we will also beat this. It's just that the market will take some time to recover. But yeah, I mean, these are some of the best times to invest. Over the next 3 to 4 months, you should go aggressive on your SIPs if you're investing in mutual funds. And if you're looking to build your own direct portfolio in your demat account, slightly go aggressive now. We also advise our clients in terms of when the market is overheated and when it is uh, the other way around. So in situations where it is undervalued, we will tell them, slightly go aggressive on your investments. And when it starts to get into that overbought zone or the overvalued zone, then we'll tell our client that, uh, stop putting any more money in this small case, right? We'll wait for better valuation to then enter more, right? And what we've also thought to do is we will, for example, make these small cases inactive during during phases where the market has gotten overvalued, right? Because out of my experience of dealing with small cases, what happens is that when uh, there are a lot of retail investors come, especially during the bull market run, right? So
Yes.
as a fund house, you make money during the bull market, but the retail investor will lose for the next 5-6 months or even a year, right? So as a proactive measure, what we will do is whenever we are entering into a bull market, we'll just close our small cases. We'll make them offline so that nobody is able to buy these small cases at such expensive valuations, right? And we are fine letting go of that business, but because our core focus is to make money for our retail investors, and this is a learning that I have sort of got through my past experience of having been associated with a couple of small cases myself. So we'll try and do this so that we avoid, at least our investors, people who are investing with us, they sort of don't invest their money in when the market is sort of very overvalued and in the overvalued zone. So right, I will only add here that we are co-invested with you, so we invest in the same companies that we are advising all our clients to do. And like you've seen, we are very focused on uh, deep research. uh, we unless we understand the business, we'll not put our money no matter how much everybody else is excited, right? So that's our sort of thought process, and we'll bring that conviction and we'll bring that uh, you know what do you say, conviction to when we're investing in these stocks, which is why we limit it to 10 to 15 stocks, right? We don't think uh, taking exposure beyond this makes any sense. I'll quickly move ahead. Now, this is something that we are now starting to do for our offline clients. Now, this is not small case. This is something that we do for some of our clients one-on-one, which is we are open to doing VC style of investing in public market. So let's say, typically we as small investors don't get to participate in Series A, Series B, Series C rounds for companies like Flipkart, Farmeasy, where a lot of these big venture capital guys invest money. So how do we then as retail investors do venture capital style of investing in public markets, right? And you saw we selected MacPower CNC machines as one of the companies. But then there are others also. So we are, as of today, we have a good collection of 10 stocks that we have sort of picked by analyzing more than 500 businesses over the last 2-3 months. So, and like I said, we follow a tranche type of investing. So we're helping some of our clients who are slightly more risky in terms of their approach, but looking to make larger sort of bets over the long term, have huge patience, ready to test out the markets, and ready to also sort of take some hits also. It's not that all these bets will come through. Some of these bets will be loss making also. But then, you know, 1 or 2 of these bets will actually cover for more than your losses. So that's the approach. We are intending to do 8 to 10 high conviction stocks where we understand the business model in a lot more detail. We have spoken to the management. We follow their quarter-on-quarter results very keenly and stuff like that. And you know, we help some of our clients do this VC type of investing in public markets. And here our process is very simple. The only, like I said, we only focus on 3 things, that is execution, execution, and execution. If the execution is not coming through, we will not stay invested. We will exit those companies. We will, even if it is at a loss, we will exit those companies and we move our money to companies that are executing. That's how we increase our winners and we reduce our losers, right? But again, this is only for some companies. So these were clients who are sort of ready to sort of accept that sort of risk and ready to put in capital at regular intervals of time also. So ideally, a client with 1 lakh capital cannot do this style of investing. So typically, you would need at least 10 lakhs because you're investing in 8 to 10 stocks. So, you know, for you to make any sort of significant returns and for us to justify the effort that we're putting in identifying these stocks, we would recommend at least 10 lakhs, you know, for people to invest in these stocks. These are some examples I have mentioned. Again, no recommendations. These stocks are mentioned here so that you can go through these companies for yourself and try and see if you sort of, you know, if you like these companies and the sort of approach that we are taking to find this sort of companies, right? So MacPower CNC, I already took you through, but then there are companies like Flex, DHP, MNC. And what else are we looking at? So typically MNC small cap stocks are a favorite bet, right? Because you have a very strong promoter, but a small cap company, and it's an MNC company. So there's technology available, product available. You just have to scale the business. So slightly more easier bet, you know, so that those are the kind of, you know, stocks that we're looking at, especially when we do this VC style of investing in public equities. But then, yeah, for the retail investors, people can definitely start with as low as, you know, 1 lakhs. Our fees is very reasonable to that extent. You will not find us, you know, expensive. So yeah, that's it. I will end it here, and if there are any questions, then happy to take them.
Yeah, thank you, Ujjwal bhai. That was a very wonderful presentation.
Thanks a lot, Falak. Yeah, you know, I'm very happy to sort of do this with you.
In fact, it was our learning experience because investing in multiple stocks without any process. This will help us in creating some process.
I hope it does.